For many American working professionals, monthly income hasn't collapsed, but flexibility has. Rising mortgage payments, higher property taxes, health insurance premiums, and retirement contributions are quietly consuming a larger share of take home pay. The issue isn't earning less, it's having less room to move. Over the past decade, many salaried professionals in the United States experienced steady income growth. Promotions came, bonuses improved, job mobility expanded. For a while, financial comfort felt durable. But recently, something has shifted. The challenge isn't sudden unemployment or a dramatic pay cut. It's subtler than that. Many households are discovering that while income has stabilized or modestly increased, fixed costs are rising faster, and those fixed costs are reducing long term flexibility. This shift affects mid career professionals, dual income households, homeowners in suburban markets, and even high earners in metropolitan areas. It's not isolated to one income bracket, it's structural in nature, and it changes how financial comfort behaves over time. Let's look at what's happening. Mortgage payments are a starting point. For those who purchased homes in the past 5 to 8 years, monthly housing costs often stretch a larger percentage of income than they did for previous generations. Even homeowners with fixed rate mortgages are seeing related expenses increase. Property taxes reassessed upward, homeowners insurance premiums adjusting, maintenance costs rising with labor inflation. Housing remains stable, but more expensive to maintain. Property taxes, in particular, have become an ongoing pressure point in many counties. Municipal reassessments have reflected higher property values, and while equity may have increased on paper, the annual tax bill rises regardless of whether the home is sold. This creates a situation where wealth appears higher, but liquidity feels tighter. At the same time, health insurance premiums have steadily increased. Employer sponsored plans still cover a portion of costs, but deductibles are often higher than they were a decade ago. Out of pocket maximums have grown. For families, especially those with dependents, healthcare expenses now represent a predictable and significant fixed category. Retirement contributions add another layer. As income rises, contribution percentages often increase, either by employer auto-escalation or by personal decision. A 10% contribution on a $70,000 salary feels different from 10% on a $120,000 salary. The nominal income may be higher, but the actual take-home pay can feel constrained when higher contributions, higher taxes, and higher benefit costs are factored in. This creates an interesting tension. Financial discipline increases, but short-term flexibility decreases. For many professionals, car payments have also shifted upward. Vehicles have become more expensive. Interest rates have increased compared to the ultra-low environment of the early 2020s. Insurance premiums for vehicles have also adjusted upward due to repair costs and replacement values. Each category on its own may appear manageable. Combined, they reshape monthly cash flow. What makes this environment different from a recessionary period is that employment may still feel stable. Salaries are steady, work continues. There is no immediate financial crisis, but flexibility, the ability to redirect money, absorb a new expense, change jobs, relocate, or pursue a lower paying opportunity becomes narrower. Financial comfort traditionally meant that bills were covered and savings were accumulating. Today, comfort often means that obligations are consistently met, but with less room to pivot. This matters for long term planning. Consider career mobility. A professional who once felt comfortable accepting a role with slightly lower pay but stronger long term growth potential may hesitate now. Fixed costs create anchoring pressure. A mortgage payment, property taxes, childcare, insurance premiums, and retirement contributions together create a baseline expense level that requires a certain income threshold. The higher the baseline, the fewer options feel viable. Geographic mobility is also affected. Selling a home and purchasing another at a higher interest rate may not be appealing. Relocation costs add friction. Even remote workers who once had the option to move to lower cost areas may now face housing markets that have normalized at higher levels. Inflation contributes in less visible ways. Groceries, utilities, service fees, subscriptions, none may individually disrupt a household, but incremental increases across dozens of line items accumulate. Over time, discretionary spending shrinks quietly rather than dramatically. Dining out becomes less frequent. Travel becomes more deliberate. Home upgrades are postponed. There is no single event that signals the shift. It unfolds gradually. Another component is taxation. As salaries increase, marginal tax brackets adjust. State income taxes in certain regions further compress net pay. Bonuses, while welcomed, may feel smaller after withholding. The psychological effect is important. Gross income grows, but net flexibility feels unchanged or reduced. This dynamic changes how professionals evaluate financial progress. In previous cycles, income growth often translated into lifestyle expansion and savings growth simultaneously. In the current environment, income growth may primarily stabilize existing obligations rather than expand opportunity. Financial comfort becomes maintenance oriented rather than expansion oriented. For younger professionals entering their 30s and 40s, this phase coincides with peak responsibility years: mortgages, children, retirement funding, career development. The layering of commitments naturally narrows flexibility, but higher structural costs amplify the effect. For older professionals approaching their 50s, the focus may shift toward retirement catch up contributions, long term healthcare planning, and college tuition assistance. Again, income may be strong, but allocated. This doesn't indicate financial decline, it indicates financial density. Income is present, assets may be growing, net worth may be increasing, but liquidity, the immediate freedom to reallocate resources, feels constrained. The distinction between wealth and flexibility becomes clearer in this phase. Home equity increases net worth but doesn't reduce monthly expenses. A rising 401k balance supports long term security but doesn't ease current cash flow. Employer stock grants may vest gradually, but immediate obligations persist. This environment encourages stability but limits experimentation. Professionals may remain in roles longer. Entrepreneurial exploration becomes harder to justify. Part time transitions feel risky. Even negotiating for reduced hours can conflict with fixed cost structures. Financial comfort still exists, but it functions differently. It's also important to recognize that this shift is not universal. Some households maintain low housing costs due to earlier purchases or lower cost regions. Others have minimal debt and higher savings ratios. But for many, particularly those who purchased homes recently or live in high growth metro areas, the compression is noticeable. Over time, rising fixed costs reshape financial psychology. Decisions become more conservative. Risk tolerance decreases. Emergency funds carry greater importance. The margin between stability and stress narrows slightly, even if income remains healthy. The broader economy reinforces this dynamic. Interest rates influence borrowing costs. Insurance markets adjust premiums. Local governments revise property assessments. Healthcare pricing structures evolve. Each system moves independently, yet together they influence household flexibility. What's distinctive about this period is not instability, it's rigidity. Households are financially intact, but the system around them is less forgiving. Flexibility, historically, has been a quiet asset. It allows career changes, relocation, education, entrepreneurship, or temporary income reduction without disruption. When fixed costs rise relative to income, that asset gradually erodes. This doesn't mean financial planning has failed. It means the environment has shifted. Financial comfort once expanded options. Increasingly, it preserves position. For working professionals across the United States, recognizing this distinction is important. It reframes the experience. The feeling of constraint isn't necessarily mismanagement. It may reflect structural cost growth intersecting with mid career responsibilities. Over the next decade, income may continue to grow, asset values may continue to rise, but the relationship between income and flexibility will likely remain central to how financial security is perceived. Comfort is still present, it simply carries more weight, and weight changes how easily we move.